Hi, my name is Joanne Kiritsis, and I'm a mortgage broker and an affiliated professional with the Real Estate Buyers Academy. Today I'm going to talk to you about what lenders are looking for when lending you money. First, they need to see if you qualify with your income. If salaried, they will require a letter of employment on company letterhead, not handwritten. Along with a date, the letter needs to be recent and not from, for example, 2 years ago, since we want to ensure that you are still working there. The date of firing, ideally they want to see 2 years or at least 6 months at the current job and another year and a half at a former, ideally similar job. Your position, and finally your gross annual salary. Note that lenders qualify their clients with their base salary and not with overtime, bonuses, or extra commissions. The reason is that these amounts may vary from week to week, month to month, and year to year, and are therefore not considered stable. Along with the letter, lenders ask for 2 recent pay stubs confirming the salary stated on the employment letter. If self-employed, lenders need proof that you are self-employed. So it's either a copy of your registration with the Registraire des Entreprises du Québec, CIDREC, or your business license, or your GST-PST return summary, your T1 General with statement of business activities for the last 2 years, audited financial statements for the last 2 years, and finally your articles of incorporation. They then need to see your notice of assessments, NOAs, for the last 2 years, and they take an average of the income. After confirming the income, the lenders need to see the proof of down payment. This can be in the form of savings in your bank account. We need to see the last 3 months or 90 days of bank statements if in cash, your investment accounts, RRSPs, etc., or a gift from an immediate family member, father, mother, brother, sister, and sometimes grandparents are acceptable depending on the financial institution. Only if owner-occupied, the minimum amount required for a single-family dwelling, including divided condos and duplexes, is 5%. For a triplex and fourplex, the minimum down payment required is 10%, and 5 and up is 15% and over. Speaking of multiplexes, the amount required is based on the economic value. Lenders lend up to 75% of this economic value, which is basically revenue minus expenses. The economic value is usually lower than the market value. Hence, the amount of down payment required is more than 25%. So for 1 to 4 units, if the down payment is less than 20%, the loan must be insured by one of Canada's 3 insurers, CMHC, Genworth, or Canada Guarantee. An insurance premium is charged, which is amortized in the loan and does not need to be paid upfront. For multiplex properties, the loan can also be insured, in which case the loan amount is 85% of the economic value. The down payment required, therefore, can be as low as 15% if the economic value equals the purchase price. Lenders also need to see that clients have 1.5% of the purchase price for closing costs. These include the notary fees and the real estate transfer taxes, or as they are commonly called, welcome taxes. For example, for a purchase of $300,000, clients must have in savings $4,500 in addition to the down payment amount required. After the necessary requirements with respect to income, lenders like to see a good credit report, ideally a Beacon score of 680 and over. Please see my other video on credit reports with the details on what this score is and how to improve it. The minimum credit score A lenders accept is 600. A lenders are the traditional banks having branches, as well as non-traditional mortgage financing companies or non-bank lenders having no branches and are therefore referred to as virtual banks. Below 600, we need to look at B lenders, of which there are not too many anymore, or finally private lenders. When dealing with these alternative lenders, the interest rate charged for your loan will be higher and there will be additional administration fees charged as well. It is therefore in your best interest to maintain a good credit score in order to qualify for a loan with an A lender. The amount of debts individuals have also plays a key role in qualifying for a loan. These include credit card debts, lines of credit, student loans, car loans, and other mortgages. The debt and income ratio must be satisfied in order to qualify for the loan. As opposed to debts, another factor which strengthens the financial profile of a client is their assets, ideally totaling more than the down payment and closing costs. These include investments, life insurance, motor vehicles, and other properties. Finally, the property in question must be acceptable based on the lender's criteria. Location and type of property is key. Ideally, lenders like properties in urban populated areas like downtown Montreal as opposed to rural areas such as Rawdon. No offense to the people of Rawdon, however, the smaller the population of a town, county, or city, the more difficult it is to find potential buyers of properties situated in such locations, which lenders interpret as higher risk. Also, a four-season solid property having a foundation is preferable as opposed to a three-season chalet-type property, mobile home, or just plain land. Up to now, I talked about qualifying for a purchase of a property. When refinancing, lenders lend up to 80% of the market value of your property. If, for example, you own a house worth $350,000 and have a mortgage of $210,000 or 60% of that market value, you can refinance to obtain an additional 20% or $70,000 for a new total loan amount of $280,000. In short, stability is key when qualifying for a loan. Thank you and see you again next time.